how does build to rent work? Build to rent is absolutely booming. There's a lot of interest, a ton, billions of dollars of capital being pumped into build to rent real estate projects. So in this video, I'm going to break down first at a 30,000 foot view of how build to rent works. And then I'm going to take you into the trenches of exactly how putting together build to rent projects actually works in the real world. We actually have one on the go right now. So I'm going to take you behind the scenes and break down how you put those deals together in the real world and how you can make it work, whether as an active operator, somebody looking to do those deals, and also if you're somebody who has the capital and you're looking to passively invest in projects like this, what does it look like? What does it entail? What are the things you have to know as it relates to investing in build to rent real estate projects? So without further ado, let's get into it. I have a lot of stuff I want to cover today. So first of all, 30,000 foot view of build to rent projects. What is it? How do they work? What are some expectations? Well, when we look at build to rent projects, we're essentially combining two different types of real estate assets and bringing them together and getting the best of both worlds. All right. So on the one side right here, we have apartment buildings. Right? Multifamily. What are the benefits of multifamily real estate? Why do people actually want to invest in multifamily? And CBRE actually did a study where they looked at the past couple of recessions, and they found that multifamily apartment buildings were the most resilient asset class to recessions. So it's a no-brainer why the wealthiest people around invest so much capital, put their money into apartment buildings, because it's incredibly stable. When things get choppy, apartment buildings, they're usually the first asset to surpass the previous peak, which means they rebound faster, and the downturn in terms of rents is lower, or it's less than if you look at retail, office space, industrial. And that's why multifamily is so incredibly stable. Okay. Plus, that's why banks love lending on multifamily assets, because they know it's so stable, right? So with multifamily, we get efficiency because we have hundreds of units under one roof. You have a 150 unit apartment building, everything's under one roof. You get the economies of scale working in your favor. You've got one roof or several roofs, depending on your layout, whether you're mid-rise, high-rise, or garden style. Incredibly efficient. But more importantly, when we look at stability, and we saw this with COVID, right? You had office took a huge hit, retail took a huge hit. With multifamily, people will not give up their home. That is the last thing they want to give up. They will close the doors on their business. They will leave the office where they live with their family. That is the last bastion that they will give up. And that's why during the downturn COVID years, multifamily, incredibly stable in terms of occupancy and rents, because people need a place to live. And that's the product we're selling when we have an apartment building. And then we have lending. So like I said, incredibly stable when it comes to lending. Banks love lending on multifamily. So these are the reasons why people love investing in multifamily. But then on the other side, we have single family homes. With single family homes, the tenants stay longer. Why? Because when you live in a single family home as opposed to an apartment building, it feels more like a house. People see themselves with the white picket fence. They see themselves with the dog. They see themselves with the 2.5 kids. That's the type of feeling you get when you live in a home. Plus, you don't it's that dream everybody has. So if somebody has a family or they're looking to start a family, they're newly married, the tenants tend to be stickier and stay longer if there's a single family home involved rather than an apartment building. If you compare the two, you're going to get more stickiness with this single family home, right? And then the wear and tear with single family homes, if somebody's living in a home, generally speaking, they're going to take more pride of ownership, even though they're renting, right? So they're going to take a little bit better care of the home rather than the apartment. It's just perception, right? And the feeling you get. So why did I explain all of this stuff when I'm talking about build to rent? Well, the reason is we can combine the benefits of both. Because with single family homes, and you want to scale a portfolio of single family homes, incredibly inefficient. You've got properties everywhere. Imagine having 1,000 roofs, right? 1,000 different properties, houses all scattered around. Well, you can have 1,000 units easy with multifamily. You can have 3 or 4 deals and there's your 1,000 units. It's way more efficient. Plus, with single family homes, financing is a pain in the butt. I ran into that when I was doing single family home investing. But with apartment buildings, the lending side, banks love lending. So we want to combine the stickiness and the pride of ownership, even though they're renting, that type of stuff with the single family homes. And we want to combine it with the efficiency, stability, and the lending. And that's where build to rent comes in, because this is build to rent in a nutshell, 30,000 foot view. We're going to build a purpose-built community. So let's say this is our community right here with all the roads coming through. We're going to build a purpose-built community of single-family homes, but we're building it to our specs and we're going to manage it and treat it and finance it just like we would with an apartment building. So we're going to get stickier tenants. We're going to get less wear and tear. We're going to get more pride of ownership, single family homes. We're going to be able to charge more for each of those units. But we're also getting the efficiency of managing everything under one roof, so to speak. We're going to get the stability that comes with multifamily, and we're going to get the lending terms, because the banks basically treat build to rent like an apartment building, even though it's all the houses all over the place. And with build to rent, you can do duplexes, so side by side. You can do townhomes in terms of build to rent, or you can do single family homes, standalone homes, and have 100, 200, 300 of those in one community. And then you'll have the amenities, just like a garden style apartment building would. You can have the pool, you can have the clubhouse, the business center, the gym, the dog park. All of that applies. We treat it just like a low-rise garden style apartment building, except we're building this to spec. Now, why would somebody actually want to build a community like this from spec as opposed to just buying it? Well, number one, we know what the tenants are looking for. We've done our research in the marketplace. So we know exactly what we want to build to maximize the rent. And then also we know the materials we want to use for longevity in terms of, this is the type of flooring we have tested, we have in our other units. This is what we like using. This is not what we don't like using. We have full control. And then we also control the layout and then the timelines. Are we building all of the units at once? Do we have a 3-phase plan? What's going on there? 30,000 foot view. That's what build to rent is. We're basically taking the stability and the financing, all the terms, efficiencies of apartment building investing. We're combining it with the stickiness, the family feeling of single family homes, the increased rent that we can charge because of that, combining it together, purposely building an entire community that we will then manage just like a multifamily asset and finance it the exact same way. That's the 30,000 foot view. Now, let's get into the sticky, the itsy bitsy, the teeny weeny, the nitty gritty details. Because like I said, we are in the middle of a build to rent project. And there are some key things that you have to be aware of if you're going to successfully execute on a build to rent project. So number one, we have to worry and concern ourselves with comps, comparable properties. And this is where understanding your market becomes so important, because the last thing you want to do is just build a community without doing your research. We want to find clues and examples in the current market of what's working so we can replicate and do the exact same thing. This is what I mean. If we're going to embark upon a build to rent project, we want to find another build to rent project, ideally in the marketplace, that has executed on their business plan. Why? We're going to know what rents they're charging. So how much are they getting per unit? We want to know layout. So this is going to be bedrooms, stories. This is going to be, do they have separate dining rooms? Is it combined with the living room? All of that type of stuff. And then we also want material and costs. You have to do a ton of research. Why? I need to be able to know with certainty what I can achieve with my build to rent project as soon as a unit's completed. It's not, hey, guessing, hopefully we should be able to achieve, $1,750 a month. No, there are 150 other units just like this one that are achieving $1,700 a month. I know that I can achieve the same thing if I just replicate their business plan. That's the certainty we're looking for with build to rent. There's no guessing. We have to know for sure. And to do that, we have to look in the marketplace and find those comparables, those apples to apples, those comparisons that we need. Then with layout, every market's going to be different. There's going to be a difference between a 3 and a 4 bedroom unit. There just is. But what is that difference in real life? There's the Excel spreadsheet, the hocus pocus fairy dust stuff, or there's the real life. Hey, I see in my marketplace right now, I know what 3 bedrooms are going for. I know what 4 bedrooms are going for. There's a $150 a month difference, or a $300 a month difference, or a $500 a month difference between 3 and 4 bedrooms. I need to know exactly what that is so I can run my numbers and figure out, well, how many 3 bedrooms do I want to build and how many 4 bedrooms do I want to build? And does it make sense to do so? I need to figure that out, but I'm using real numbers in the marketplace today. And how many stories? Are bungalows going to be better depending on the type of person that's going to be renting? If you're renting to an older demographic, they're going to be concerned about stairs down the road because people plan on spending more time in these communities. They get stickier. So if your customer is thinking 5 to 10 years down the road and they're an older retired demographic, stairs are going to be an issue. So that's why bungalows are going to be very, very popular. Now, if your ideal demographic is going to be younger families, well, it's going to be way more efficient. You can give more house and charge more, and your cost is going to be less if you build that second story because you've already done the foundational work. It's easy adding a second story, but then the layout comes into that, and how do we make that the most efficient? But you have to understand your market and look at comparables. If you've got 3 other comparable communities in your city, and they're all catering towards an aging retired demographic, well, that's a hint that there's a really good market there for you. But if there's nothing there, you're not going to guess, right? You have to look for proof, real life proof in the marketplace. Now, with materials, there is a big difference, a huge difference between how people build a house for them to own and live in versus how people build a house to rent out. When you're building to rent out, you're going to look at durable materials, but you're also going to look at repeatableness, or like how can you basically make this cookie cutter amongst your community. What you don't want to do is have 20 different variations of your layout across your community of 120 homes. That is a recipe for disaster when it comes to maintenance and managing your community. What you want to do is you'll probably have 3 or 4 different layouts and options as you're building out your community. Why? It's going to decrease your costs of maintaining, building that asset. If you have to import or source, like vanities for 10 different bathrooms and all those different layouts, and you're going to have different measurements, that's going to dramatically increase your cost. But if you can standardize what you're doing and have 3 or 4 layouts and everything's going to be the exact same, you're going to win on your cost because you're going to get economies of scale. You're just going to buy more in bulk. That's going to help you. But as you manage your community down the road, you're going to know, hey, is this a model A, B, or a C? Great. If something needs replacing, great. It's model B. We have that in stock. It just makes your management so much easier. And in terms of sourcing the materials, your costs, everything. And this is why and you look at the big players, like the behemoth real estate owners, they are pumping billions of dollars into build to rent for this very reason. Because when you look at, like what I did when I first started, you're going to look in the marketplace, you're going to buy a single family home retail, but it was built for an end owner. Like the builder built it for somebody to buy and live in for their family. They're not, and then you're going to end up with 20 or 30 different models of the home in all over the city, all different types. It's just not efficient, and it's going to add so many headaches to you managing your portfolio. But if you can combine everything on one property and build 100 units exactly how you want it, and you have all of those efficiencies built in, like you've got 2 paint colors, it makes it so much easier rather than having to deal with all of these different properties all over the place. And that's why build to rent, we have seen such a huge increase in number of units coming online, number of units under construction, but also the money being dumped in to build to rent. Billions of dollars being dumped in, invested into build to rent because of the efficiency of the multifamily side, but also the control we have and the stickiness from the tenants, right? So we're basically writing down our wish list of exactly how we want this to work out, and then we are executing on that business line. We know exactly what we want in that community. We know exactly what we want in the homes. Why? Not because we guessed it, because we went into the marketplace, did our research, and we found the most efficient way to lay out the properties to maximize rent. We know the exact materials that are achieving a premium in the marketplace. We know the features that are achieving the premium in the marketplace. We are engineering this community, this build to rent community, to be the most profitable for not only us, but also the best for the tenants. Because if the marketplace is telling us that tenants are willing to pay more for these features and these materials and these layouts, well, there is a value in the marketplace for those tenants, or else they wouldn't pay for it. So we are providing the best tenant experience by customizing this build, but also maximizing our returns for our investors. Perfect. Everybody's winning here. The tenants get a better home that they actually are willing to pay more for because it has what they're looking for, but also we're maximizing our investors' returns. So how does somebody actually set up a build to rent project from the operator side or the passive investor side, right? So we're syndicating this deal. Now, we have a lot of Canadian investors. This deal is in the States. We actually have a special fund structure where we eliminate all of the hassle, the paperwork, the back and forth crap that you encounter as a Canadian investing in a US entity for real estate. We actually take care of all of that. We've spent a lot of money and a lot of time setting this up to make it the easiest, most efficient way for a Canadian to invest in US real estate. So we've got that. Now, for Americans, because we have a ton of American investors as well, it acts as what you would encounter as a typical syndication. So let me break this down just so you're educated and you know how this works, both as an operator, but also as a passive investor, because we raise a lot of money for these deals, and we're able to help a lot of investors get better cash flow, make their money work harder for them, get tax benefits. There's a lot of good that comes out of investing in real estate. And this is why we have a ton of investors who continually invest in our deals. So what we have is we have two sides to a real estate syndication like this. We have what's called a limited partnership. These are the passive investors who have capital to invest. So maybe they're business owners, doctors, lawyers, programmers, whatever it is. They have money. They're busy doing what they do best. Maybe they run their business, maybe they run an accounting firm, whatever it is. They just don't have time to basically run and manage a build-to-rent community because it's a lot of work, okay? So we've got LPs. Now there's us on the GP side. We're also called sponsors. Our company, we have the track record, we have the connections, we know what we're doing. We basically manage this stuff full time. So what we do is we raise money from our investors on the LP side. That gets put together because on its own, let's say one of our investors has a $200,000 nest egg that they want to invest. On their own, they could not invest $200,000 and have a built and be an owner of a build to rent community of 100, 150, 200 homes. It just doesn't work, right? Or an apartment building, because we do a lot of apartment building stuff. It just doesn't work that way. But when we're able to group and combine all of our investors' funds, if everybody puts in $200K, now we actually have a sizable amount. So whether it's a $5 million raise, a $10 million raise, $15, $20 million raise, it works the same way. So we bring our investors together, right? And so they act as the LP. They were bringing the money to the equation, the capital. Now on the GP side, we find the deal, we manage the deal, we take care of the financing side, because I break it down this way. So this is the real estate matrix, right? You need to have the deal, you need to have the equity or the capital, you have to have the financing, and then you have to have management. If one of these pieces is missing, the deal doesn't happen. Very, very, very important. So I call this the real estate matrix. So what we do on the GP side as a real estate professionals, we bring the deal, we manage the deal, and we also finance the deal. Now, on this side, the LP, they are bringing a portion of the equity. Now, we as the GP side, we bring our own money into the deal as well, but the LPs, they're bringing equity into the deal. So we're basically partnering with our investors to get this deal done. And as it relates to build to rent, so what happens is the LPs will invest in the project. We're executing on the business plan. We've already got the land wrapped up. We've got all of that under contract. It's ready to rock and roll. So the LPs are investing in the project, and then away we rock and roll. And now we're basically purpose building this rental community exactly how we want it. And the numbers are quite attractive. So that's how syndication works now together. So let's say BTR, this is our community. So the LP will plug in here, the GP will plug in here, and we're basically offering shares in the syndication. So there's going to be some different classes of shares up here. So this is what's called a capital stack. So this is going to be the debt from the bank. And then we're going to have the LPs right here, and then the GPs right here. So basically the GPs are controlling the asset. We know what we're doing. We've got the team, we're making all the decisions, we're executing on the business plan, and the LPs, they own a piece of the deal. And this is why it's not just, you're not owning a stock, you're owning a piece of the deal. And this is very, very different from buying a REIT or something like that, on the stock market. You're actually owning a piece of the deal. And this is why so many passive investors love investing in real estate this way. They're not managing a duplex on their own. They're not buying a condo and renting it for the next 20 years and hoping to pay it off. They're investing in these large real estate projects that produce sizable returns, and they don't have to lift a finger, right? It's totally passive. And now the general partnership, our company comes in and we do all the heavy lifting. So that's how a syndication works in a nutshell. And that's how we approach these build to rent projects. We know exactly the land we're building on. We've done all the homework. We know who's building it. We know the cost. We know all of that type of stuff. And then we go to our investors and say, hey, listen, we've got this project. Do you guys want to participate? And everybody raises their hand. And if you're not part of that community, if you're not part of our list, you definitely want to become a part of that list. So you get a heads up on the next project that's coming up, and then now you can be part of that VIP who gets first crack at all of our deals. So if this is something that's interesting to you, you just have to go to sethferguson.org/invest, and you can set up a call with my team. We'll we'll figure out, hey, like, what's your current situation? Where are you at? What are your goals with your investing? And we can see if what we're doing is a good fit. It may be a good fit. It may not be a good fit, because there's certain criteria that we're looking for as well from our investors. So if it's a fit, great. If not, that's okay. We'll point you in the right direction. But go to sethferguson.org/invest to learn more about our build to rent deal, about our multifamily apartment building deals, the benefits of single family homes and the white picket fence in the community there. Bring them together and build something that's absolutely going to crush in the market, but also deliver a superior product to our customers, our tenants. That's build to rent in a nutshell. So I hope this was helpful. If you're interested, book a call. Let's chat. Let's see if there's a fit there. And if not, I will see you in the new year, because we are in the last final days of 2024, and I'll see you in 2025. See you then.